2 negative years before and then 13 years of positive performance. What else makes you bullish on this market right now?
Yeah, so I think it's two things, and I'll get into these comments to talk about the sector positioning, but it's the way we've got the portfolio position in terms of the sectors we're in. So we're overweight to industrial and residential. We still feel very strongly about the underlying fundamentals. I think the thing to point out about the current valuations is office has.
It's not right. On the police and fire side, that and Brock Bell, Tom Palomar, and Eric Calder and David Becker. All right, let's move. And thank you to BlackRock, and thank you to Principal for coming with us this evening. Let's move to our first item up this evening, which is the investment manager review with the Principal Real Estate Fund.
Chart to the Odyssey.
Thank you for joining us remotely. I think we tend to see you around this time of the year, right? I think you tend to get that October slot. I look forward to hearing how the year has been, and in general, generally have you do the simple review what happened, how you ran through it last year, and allow for a little Q&A.
Excellent. Thank you. Can everybody
chart to the Odyssey?
Yes.
Very good. Well, again, you're right. It's been this time of year each year, and good to be back. My name is Paul Stover, Relationship Management here at Principal. I'm joined today by Brent Heemskirk, who's a member of our portfolio management team on the Enhanced Property Fund, and then Matt Murdoch also joining. Matt just recently joined our relationship management team from Aberdeen, so pleased to have him with us. He's based just outside of the Boston area, and he'll be
chart to the Odyssey.
Institutional clients in the Northeast and partnering with me going forward on this relationship. So excited to have Matt on board as well. I know we've got scheduled about 15 minutes or so. Is that still work for everybody before we get started with our comments today?
Yeah.
Very good.
Chart to the Odyssey.
High level, I can share my screen if you'd like us to share a screen, or would you prefer to have us refer to slides as we go through?
I'd like to refer to the slides. So I think
very good. Okay. Well, I'll be real brief from an organizational standpoint and a team standpoint from the Enhanced Property Fund team. No changes to the team, no material changes to the organization since we last spoke. We've enjoyed the opportunity to work with Black
chart to the Odyssey.
The transition here the last several months as well. And so unless there are any questions for Matt or me related to the organization, in the interest of time, I'll turn it over to Brent to jump into the review of the portfolio. Hearing none, Brent, I'll turn it over to you.
Yeah, thanks, Paul. Can everybody hear me?
Yes.
Good evening, everyone. Good to see you all, whether virtually or it's like a big group in the room. Chart to the Odyssey to jump on and give you guys a brief update. So appreciate the time and attention in the business, certainly. Given the brief time period, I'm just going to focus on kind of 3 high-level things, and certainly we'll leave some time for questions at the end. So anything I don't cover, feel free to ask either as I'm going through or at the end of kind of my prepared remarks. But Paul, are you going to share slides, or maybe we'll leave them down and everyone has them?
Go ahead and just refer to the
chart to the Odyssey. Okay. Just want to make sure everyone virtually has them too. But I'm going to start on page 19, which is the fund performance summary. Want to point out, so I'm going to cover basically 3 things. I'll talk about the state of the real estate market, kind of high-level thoughts. I'm going to do that referring to kind of the return slide. Then I'm going to spend a couple minutes going through our portfolio positioning, kind of how we've oriented this portfolio. I'll go through our thoughts on each of the main sectors and kind of you'll get some chart to the Odyssey. Current thoughts on each of those sectors and where we're seeing opportunities. And then finish up with kind of looking forward, what we see the rest of the year and what we're getting excited about in terms of deploying new capital. So I'll start you on page 19, which is a second quarter deck. Apologies, when we sent this deck out, we didn't quite have third quarter numbers. So I will update you with the third quarter numbers. What we have in front of you is the second quarter numbers. And what you'll see here, you'll see 0.73% chart to the Odyssey at the top. The reason I'm pointing that out is that was in the second quarter, the first positive return after 6 straight negative quarters. We think that's noteworthy. think about private real estate, I'll show you a chart here on page 20 in a second, about the way private real estate tends to work is a little bit more slow and steady than the public markets. And so typically once we found a bottom, historically it's been a pretty nice chart to the Odyssey return. So we did get that first positive return in second quarter, 0.73% gross return. I'm happy to report in third quarter, slightly more positive. So it'd be a 0.84% gross return in third quarter. Now that doesn't tell you a whole lot about the inner workings of the sectors. I'll get into detail there, but I think at a high level, it's good to know that we've now got 2 consecutive quarters of positive returns. You will see as we compare ourselves in that chart to the Odyssey Index, our benchmark, the benchmark is still slightly negative. So we're doing a little better than the benchmark. That's good. But we think we're close to, if not at bottom, generally speaking, of asset write-downs and then kind of the revaluation we've seen over the last year and a half, 2 years. If you peel that onion a little bit of kind of where that's coming from, we feel pretty good about 3 of the 4 main property types. And I'll give you a little more detail on all of these, but just at a high level, office being the one that, there still could be some more downward movement going forward. I'm not sure that one has quite reached bottom in terms of asset valuations. But what we see in industrial, in residential, and in retail all feels pretty good. And I say that from an ownership perspective of how our assets are performing, and also what we're seeing on the sales side when we're going to sell assets in the market. Those are generally been at or above our carry values. And then as we've participated in looking to acquire new assets, we've been outbid on some things. And so that underlying makes us feel pretty good about asset valuations in 3 of those 4 main sectors. So what I'm trying to portray here is some optimism going forward. I want to point out the performance summary, even though it's a quarter dated now on page 19, but 2 positive quarters, hopefully a trend here going forward in terms of overall performance. I alluded to it, but I'll point you to slide 20 now for some historical context. And I've kind of already given you the high level summary of this page, but this is a 45-year look at the NFI Odyssey Index. So you can kind of think about it as the private real estate returns across the industry. This goes back to 1978, and we've shaded the annual returns. We've shaded the negative years of negative annual returns or calendar year returns. So you'll see the 91, 92 savings loan crisis, the GFC 08, 09, and then 2023 was negative return for that calendar year. 24, I think, has a chance to be. I think our fund should be slightly positive. The index will be, I think, slightly negative or close to neutral. Either way, point of this chart is to show you historically after those periods of repricing of negative returns is historically been a very good time to get into private real estate. It has been sustained, you're talking 13 years, 15 years, 13 years, sustained consecutive years of positive returns and pretty healthy positive returns. Those periods are averaging over 11%. So I think better things to come where we've started to see that tide turn in the private real estate markets. It feels pretty good about where we sit today going forward in terms of hopefully more positive returns to come after this period of repricing. Any questions on performance before I kind of turn to the portfolio makeup and how we've oriented this portfolio?
So rather than just looking at historical performance of we've had 2 negative years before and then 13 years of positive performance, what else makes you bullish on this market right now?
Yeah, so I think it's 2 things, and I'll get into these comments to talk about the sector positioning, but it's the way we've got the portfolio position in terms of the sectors we're in. So we're overweight to industrial and residential. We still feel very strongly about the underlying fundamentals. I think the thing to point out about the current valuations is office has driven a lot of this write down and this revaluation. The underlying fundamentals in office are still very challenging. Higher vacancy, return to office has been slow, but industrial, residential, and retail vacancy is still pretty low. Landlords have pricing power, rents are increasing, and so the underlying property fundamentals in all of those still feel pretty good. The repricing we've seen over the last big ones have been kind of market driven in terms of a rapid rise in interest rates, and that has put pressure on kind of valuation metrics. We're seeing that stabilize today. And it's actually somewhat of an opportunity to buy at, reset basis in some of those sectors where, again, we still feel pretty good about the underlying fundamentals. And I can get into a little more detail on each of those individually as I go through kind of these next 3 or 4 slides. So anything else on this page?
Next big ones come.
To actually go to page 18 for a high level summary of kind of where we sit within this portfolio, the Enhanced Property Fund.
Quick question on refis. Do you have any office properties that need to be refied in the next 12 months or so that give you concern?
Yeah, great question. Anything?
And that give you concern? Two
I'm
questions.
sorry, I started talking and I didn't hear.
Two questions. Do you have any coming up in the next, big ones coming up in the next 12 months? And then in addition, do you have any that give you concerns in the next 12 months? On the office side.
Yep, so let's hit the first one, refis. It's a great question. It's a question we've gotten for the last year or so. And it's a very accurate question. We have one additional office refinance in the next year. That one comes up the end here of 2024. We have a 1-year extension that we do qualify for on that asset. So it's a office building, some sort of property that they are. It's actually performing quite well. It's 99% leased, strong cash flow. I think we will use that extension option and kick that can sort of down the road a year from now. At that point, we will probably have a decision to make. We would like to sell that asset if we could. The question is, will we get pricing that we like? If we don't, the question will be, do you want to refinance? Will banks be more willing to lend on that sort of property than they are today? Or will we need to put cash into that property and sort of put equity back into that deal? Likely that if we had that choice today, we would probably not be willing to put more equity into that. We just think there's better opportunity in other property types today. Better risk-adjusted value, if you will, is probably the best way to think about it. So to answer your first question is we have one coming up in the next year with a 1-year extension option that will kick it to the end of 2025. That one is, so we've got some time on that one. It's currently performing well. It's meeting all the debt service covenants. There's no immediate pressure on that one, but that will be the next large one. It's actually not that large of a loan, to be completely honest. That one is.
Does that more of that building represent?
Oh, it'd be about a $40 million asset, so less than 1%.
And Brett, maybe comments as to current valuation would be reflected today.
Yeah, so that one is carried at its loan balance. So there is, from an investor perspective, there's no future downside on that. That's a great point, Paul. That one is being carried at its loan balance. So there's, from a return perspective, there is no future downside if we're to give that one back to the bank going forward.
And what's the NOI as a percentage of the loan?
One's about a 14% cap rate. And I believe your second question was anything else that worries us today? Was that, I thought I caught it?
Yes.
Yeah. I mean, well, I'll flip you to the sector slides a minute here and just go through these briefly. The quick answer is, office is still very cheap. There was some, we've reduced our exposure there significantly, but we do have an office building in Portland that is 50% leased to Amazon. So they make up a large percentage of that rent roll. We do have a non-recourse loan on that one as well. They have a termination option, so the lease goes out for another 5 years. They have a termination option at the end of this year. If they were to notify us that they were, terminating that lease, that's one that would probably also go back to the lender. There was some recent positive news. Amazon did announce they're returning everyone to the office 5 days a week. I'm a little skeptical if that actually occurs or takes place personally, but it's certainly better than the alternative of them saying, no, anyone can work remotely. So that would be the other, large one that we think there's maybe potential downside. That one also from a valuation perspective is carried at the loan balance. So from a return perspective, there is no downside on that one either. But that would be one that, so we were hoping for good news from Amazon here at the end of the year. If they don't tell us that they're terminating that lease, that one is well positioned, but getting a large chunk of office space back in Portland would be challenging today, certainly.
So that's
So
right.
that is pure traditional office space, yeah.
Eric Caliper here. I saw one of your most recent acquisitions is a data center. Can you, I know it's very popular on Bloomberg and some of the other talk apps. Can you talk me through that and what's your plan for the future? Are you planning to acquire more data centers or how does that work?
Yeah, great question, Eric. So I'll point you to slide 17, which is our data center slide. It's probably our favorite one to talk about today. So just maybe give you a little history or background on Principal Real Estate. So this is a deal we acquired at the end of 23, so December 2023. It's our first data center investment within this portfolio, but the data center sector is one that we've been interested in and actually have a pretty good institutional expertise. We've been investing as a firm in data centers for over 20 years. In fact, we have two specific funds large very quickly, only on data centers today, closed-end strategy and open-end strategy. In fact, this deal came to us because that closed-end fund was fully committed, and they basically walked down the hall to us and said, "Hey, would you look at this deal?" The reason we got so excited about this one is for a number of reasons, but one of them is it's a little bit of the constraint of why maybe we don't have more data centers, or the challenge of getting more data centers in this fund is the size of those deals is getting very, very large very quickly. You can easily get into the hundreds of millions of dollars, even into the billions of dollars on a single transaction within the data center space today. This one was acquired for $60 million, so it's a smaller deal, and it's a value add kind of renovation play, if you will. So it's an existing 8 megawatt data center leased to the likes of Amazon IBM and Sony. On this deal back in on this one is when we acquired it, we got approval or assurances from the municipality to increase the power to this facility. So we're going to spend some money to upgrade the infrastructure and actually increase it from an 8 to a 16 megawatt data center, and then lease that additional space. So it's a bit of a lease up value add play for us. That is going exceedingly well so far. We're in still the early stages of kind of that updating the infrastructure. But we were just honest on this deal back in the center of our leasing team, robust leasing activity and interest in this building, even for the megawatts that aren't yet available today. So we're highly confident today that we will lease it quicker than we had underwritten at rates above what we had underwritten. And costs today are coming in. The nice thing about these data centers is a lot of that upfront cost is kind of the equipment infrastructure that you can kind of lock in pricing right when we closed on this deal back in December. So the pricing risk on the renovation is mostly, we're kind of through the major risks on that side of it. So this is a deal that, again, we acquired for roughly $60 million. We're going to put roughly another $100 million into it, increase the lease by the kilowatt hour in data center space from 8 to 16. And we actually just learned recently that we think we may have the ability to get that from 16 to 24 megawatts. So I think this is one that we're profit could get to the 6 or so. This will drive a lot of the profit and the growth within the fund over the next year or 2 years. The question you asked is, will we do more of that? The answer to that is we would like to, if we can. Again, this will be roughly $160 million investment for us post that first renovation. So you see 1% on the page 17. That will get to kind of 3 to 5%. With that initial investment, I think profit could get to 6 or 7% of the fund. The challenge becomes, can you do that again, or would you have to sell that one before you kind of recycle that capital to another one? Again, we want to increase our exposure to the alternative sectors. Data centers would be one of those that we feel very strongly about. But you also don't want to get over your skis on 20 or 30% data center exposure. A lot can change quickly, and especially in a very technologically savvy sector. So love that you asked about it. It's our favorite one to talk about. I think there's some really well-positioned, exciting, creative investment opportunities in the data center space. And this is the first one that we've done. So excited about that one.
Thanks, Brent.
Let me just briefly, and maybe I'll do a quick time check. Great question. So I appreciate the interaction here, but want to be mindful of time. Let me just buzz through quickly the 4 main property sectors and give you some thoughts on each of those. We just touched on the data center slide, so that's kind of our other sector. But in order on page 13, I'm well positioned on each of the main property types. So our largest exposure is the industrial sector, page 13. You'll see 41% allocation overweight to the Odyssey Index. A sector we still really like going forward. We've been overweight for quite some time to the industrial sector. The rise of e-commerce has really driven tremendous returns in this sector. We're seeing that moderate a little bit today. It's taken a little longer to lease vacant space. Thankfully, we don't have much in our portfolio. On our stable, well-positioned 99% lease, so there isn't very much available space. We do have 3 recent developments that are in their first lease-ups. Those are taking longer than would have seen, a year or 2 years ago, but still within our underwriting parameters. Rents are still rising. The nice thing in the industrial sector is the tremendous tenant demand has changed the contractual lease structure in that sector. So as landlords now historically would have maybe seen 2 or 2.5% annual escalations, well-positioned a lease, a 5 or 10 year lease, it's now market to be 3.5 or 4% annual escalation. So we're locking those in on long-term leases. So there's really nice embedded income growth in this sector today. Rents are still catching up to contractual rents as they roll, still have a nice bump to get to where market rent is today. And so we're capturing that growth every time we roll a lease and renew a tenant or find a new tenant. So still like this sector going forward, moderating a little bit from maybe well-positioned strong growth we saw over the last couple of years, but still a very healthy market. The next sector on page 14 is the residential sector. Overweight here as well. Somewhat of a similar story to the industrial sector. We've seen rents really rise over the last couple of years. That is moderating. This one is really more supply directed. We've seen some markets, specifically in the Sun Belt region of the country, where supply has just outpaced the level of demand. Well positioned. So on new apartment rental deals, a lot of those are flat, even in some markets where you've seen a lot of supply going negative and backing up a little bit. Renewal rents are still catching up to kind of where that market is, and so you are capturing rent growth on those, but a moderating environment in those specific markets where we're seeing a lot of supply growth. But on a long-term basis, so you'll see us maybe get this overweight allocation to maybe a little bit more neutral weight in the near term, but well positioned. Feel pretty confident that the country is underhoused. It's still exceedingly expensive to buy a single-family home in a lot of metros across the country. That is still a tailwind to rental demand. Where we do see some opportunities and where we like new investment in the residential sector is some of the niche type properties. Single-family rental is one that we'd love to get in the portfolio. We've looked at a number of deals. Senior housing is another one that kind of plays off the demographic trends that we're seeing in the country. Well positioned in the portfolio, but performing fairly well. I think you'll see us pick our spots carefully as some of that supply works through the system. The nice thing about the last year or two, as interest rates have risen, construction costs have been high, that supply pipeline really did ramp down. And so once we work through kind of what's on the ground today, we do see a nice long runway of positive kind of leasing momentum and fundamentals. Well positioned is the office sector. I talked a little bit about this. It's certainly the most challenging of the traditional sectors. I'll point out a couple of things here on this slide. You'll see 16% allocation to the office sector. That's a little misleading. We've got a pie chart at the bottom to kind of unpack that a little bit. We have been rotating out of the traditional office sector for quite some time. That 16% was 44, 45% in 2015, 2016. So we've brought it down significantly since then. Well positioned pre-pandemic. We identified some trends in the office sector that gave us some pause, and really thankful that our research team really rung the bell of let's start underweighting this office sector. Didn't foresee the pandemic occurring, but that continued kind of that trend. So that 16% is just over 8% traditional office. The rest being life science and medical, which we've rotated into and out of traditional office. The other thing I'll point out here, and I had a great question on kind of the well-positioned is on an NAV basis. So that 16% would be a gross asset value. On an NAV basis, we're under 4% traditional office. So the way I would describe it is we believe very limited future downside within the office market. Again, I think this is the one, as we look across from a valuation perspective, that could have future downside. We've seen some stabilization in industrial, retail, and residential. Office is the one that is the most challenging in terms of space market fundamentals. Well positioned, very little appetite for for buying office deals today. So all of that put together, it's challenging to get to where you feel good about valuations. We think we have very limited downside in that traditional office cohort. And then the last of the traditional sectors is page 16, the retail sector. Some really nice green shoots in the retail sector. It's just 9% of our portfolio. We actually are in due diligence now on a new deal, well-positioned center, actually 2 grocery-anchored centers in Columbus. This is a sector that's performed very, very well. It's actually the strongest performing sector over the last 2 years. Lack of supply, tenants needing more space, leading to rent growth. And then the capital markets have, it never quite got those super low cap rates that we saw in industrial and residential. And so you didn't see quite the repricing that you saw over the last 18 months in this sector. So it's performed quite well. We really like the grocery, well-positioned kind of open air strip mall type centers. We have no mall exposure in this strategy. And so we will add some more to that grocery anchored kind of open air center allocation. This will get to about 10% of the portfolio, getting a little bit closer towards neutral weight relative to the benchmark. I know I'm quite a bit over my time. I appreciate the great questions. Maybe I'll pause there and see if there's anything else I can answer or anything else you want to hear from me. Well-positioned.
Why don't you take another 5 or 7 minutes and finish up what you think is important for us to hear?
Yeah. Let me point you to, I can wrap up here on, it'd be page 11 in the slides. It's just a fund profile. And what I want to get to is kind of the Q situation, which I think is interesting and a differentiator. We are in a very fortunate position from an inbound Q perspective that is well positioned in our competitive set in the open-end real estate space. So page 11 is just a fund profile. Again, these are second quarter numbers. Third quarter won't be a whole lot different in terms of GAV, NAV. I'll point out a couple things here that make us different from some of our competitive set and have allowed us to outperform over the last 13 years continuously. We learned our lesson from that. You remember the annual return chart of Odyssey. Well-positioned C taught us that leverage cuts both ways. It can be very good during good times when property prices are appreciating, but it cuts the opposite way when property values are falling. And so we took a pretty conservative approach to leverage sort of this cycle. You'll see that 34% on the low end of our target range. This fund can go up to 50% LTV. We typically play in that 35 to 45% range. Significantly on the lower end of that by design, as we saw. Well positioned. We locked in a lot of low rate, long-term fixed rate debt. That has been very accretive to fund returns. And so we're enjoying a cost of capital that is still accretive below our average cap rate on the portfolio. That is certainly benefiting fund returns and making us more attractive than some of our competitive set. Portfolio occupancy is the other thing I want to point out. You'll see 87% there, but on the stabilized assets, well positioned, really, really strong leasing. The vacancy we do have is generally in those recently delivered development deals where we see pretty good activity. So we're confident we'll get those spaces leased. And then the bottom 2 lines is the reason I pointed to this page. It's our contribution queue and withdrawal queue. We're one of a very select few open-end funds that have more inbound dollars waiting to come in than outbound dollars waiting to be paid out. So it's a very attractive position and puts us well positioned to capitalize on some of the opportunities we see in the market today. I mentioned that data center deal. I mentioned the retail deal that will close here this quarter. We also just added a cold storage. It would fit in our industrial portfolio, but a cold storage deal here this past quarter. And so we're finding deals that are priced below replacement cost. They are, the initial cap rates are below, you can put accretive debt on them. And so there's the right time to get market, and we're well set up to capitalize on those because of our Q position. And so we're very fortunate to be in that position.
Can I ask you a question?
Absolutely.
Thanks. Could you just go back? You just mentioned about the contribution queue and the withdrawal queue. And I guess, could you just explain that to us a little bit better? Because it seems to me if you have, I don't know if I understand this right, if you have $585 million wanted to come in and 261 million wanted to go out, why would there be any wait?
Yeah, the right time to, a question we get a lot. And so the answer to that is twofold. First thing is those inbound dollars, most of those are clients that we had, long-term sales processes with on the early side of 2022. So they've been waiting some time to come into the fund. And so we talk with those investors and they want to hear from us. When do we think is a good time to come into the fund? When do we think valuations have kind of reached a point where we think it's the right time to come into the strategy? And so that is a kind of back and forth conversation, making sure that they are comfortable coming in at a certain point, and also giving them our honest thoughts around where we think valuations are and if there's future downside to be had. The second thing is most of those clients want us to put those dollars to work in accretive real estate deals. They don't want those dollars just to be going out the back door to people who are requesting their dollars back. So it's really
So just to,
we want to use those dollars for new investment. We want to be able to take advantage of kind of some of the things we're seeing in the market. And then it's also liquidity constraint of making sure we're in a good spot to fund our liabilities and operate the portfolio as well. Some of that money certainly is fungible. Some will be used to pay out some of those outbound dollars. But to date, most of the outbound dollars that we've paid out have come from
so just to,
proceeds. And so that makes us feel pretty good about kind of where we sit today. We've started to call capital as we have new deals. Those clients are willing to kind of fund those dollars and come into the fund. And then we've paid out redemption requests with disposition proceeds.
So just to ask you a few more about it. So first of all, at 261 million, that's about 10% of the fund, the non-levered fund. How is that historically over whatever number of years you've been doing this at about 10% of the fund? What does that represent versus historic averages?
Yeah, so that would be higher than historical averages. It has gotten a bit higher than that in the GFC. We saw in 15% range. So it is higher, but it's fairly manageable from where we sit today. That is down now. So again, you're looking at 2Q numbers. That's going to be about $160 million today. So again, we made another payment here in October to reduce that further. So we believe we'll have that extinguished here likely in January. We'll pay out the remaining requests there. But it's sort of a management process along the way, quarter by quarter. Does that answer your question?
I guess sort of. So if somebody, let's say any investor decided they wanted to exit for any of, I can think of, 10 different reasons. How long do they have to wait?
So the way the documents are written on subscription agreements, it's at fund discretion. And the reason we have that in there is for the protection of all investors. Again, not all of our investors have those redemption requests. And so to not have to be forced to sell at sort of fire sale prices, we have that ability to sort of to gate those inflows and outflows. We try to pay that as quickly as we can. We've been significantly ahead of the pack in terms of our competitive set. All open-end real estate funds have these outbound queues today. Many of them have paid very little. They're starting to pick up that pace, but we're significantly ahead of the pace in terms of paying out those redemption requests. But yeah, that is one of the features of these open-ended real estate vehicles.
Else have any other questions?
That's one.
Okay.
One question. It's certainly made, you have a lot of good opportunities, it sounds, to add appreciation in the fund relative to the real estate portfolio. How would you, or at least could you make the case at least for, investing in real core property real estate, mostly to listed real assets, so listed real estate REIT side, where, the index now has a lot more exposure, the investment centers and some of the more niche strategies that it sounds like you're looking to get into, but deal size might be a bit of a limiting factor.
Yeah, I think I cut most of the question, cut a little bit, but make the case for why private real estate versus public real estate. Is that kind of the
Yeah, be invested in the next 3 to 5 year, or, even, I know there's probably a case longer term horizon, just, differentiator of asset, the liquidity of the properties and, a lot of the inflation and linkage that you might get. But, REITs have also been likewise battered over the last couple of years and have a very attractive entry point now, fully liquidated. For example, just, what's the case to be invested in core property rather than the listed REITs?
Yeah, so that was true 6 months ago, 3 months ago even. You've now seen that actually shift. So most of the high quality REITs are actually now priced on an NAV basis above where private real estate is. That's one of the reasons why we think it's a really good time right now. The other kind of thing I would point out relative public to private is the volatility you're going to see in the public market. The actual valuations, which you've got the underlying cash flows and the underlying, real estate, but you also have the whims of sort of the market in that public. When you see the chart on the public REITs, they go up and down very quickly. Private real estate, I showed you the chart on the ODCE Index, a little slow and, much more slow and steady. And so I think you're getting at an entry point today where you're going to see, again, back to that same slide of sustained positive growth over hopefully a prolonged period. But the actual valuations would tell you that private real estate is actually priced more attractive than public. That's just recently switched. That was not the case 6 months ago, but you have seen that switch here recently. And then I think you're going to see some nice upside in a fund like this. Again, we can do run-up development, so this is a core plus strategy. We have the ability to deploy up to 25% of this fund in value-add and development. And so we can do some creative things there. We have certainly used that bucket specifically in industrial and residential the last 4 or 5 years. That has extremely aided returns. That's where we've seen a lot of the best risk-adjusted value. With this repricing, I think there will be some deals to be had in kind of the core well lease space, and so might not need to use as much of that kind of risk-based bucket as we have in the past. But there will be a time in the medium term where we still think it makes sense to develop in certain markets. We actually just got approved this past week an industrial development office in Tampa, small bay infill product that's going to underwrite to high teens type returns, low 20s on a levered basis. So pretty attractive return profile. So we're still seeing deals like that out there for private real estate.
If we
Office.
amended and just give us some bullets in response to 3 properties that jump out at me. I'm looking at Bay Center in 60% occupancy. It's a big holding for you. And then Denton in Dallas, 0% occupancy, pretty big, 81 million. Residential, 7190 Optima with pretty low occupancy, 70%. Also a property for you. Could you just give us a bullet point on each of those 3 properties?
Office.
You haven't mentioned them as problematic so far.
Yeah, so great question. So let's go in order. Bay Center is it's a long-term hold for the fund, but it's in a repositioning state right now. And what I mean by that, it was originally traditional office 3-building asset. We emptied out one of those buildings in 2020, and converted it, spent money to upgrade the building, convert it from traditional office to a life science use. And so we upgraded infrastructure. We leased that entire building to a single life science tenant who was doing, kind of lab and life science type work. It's actually a healthcare firm doing kind of laboratory research in that building. We took that same strategy on the 3rd building. So again, 3-building kind of property was traditional office, emptied it out as those leases rolled, spent longer than our initial underwriting in that building. That one is now completed from a kind of upgrade perspective, but we are in the initial leasing of getting that 3rd building leased up. I will tell you the life science space has cooled from kind of 21, 22 timeframe. So it'll probably take a little longer than we had originally anticipated when we leased that 1st building. But we feel better about life science than we do traditional office. And so to make that investment in that building and kind of convert it to life science is the strategy there. So the answer on that, longer than our initial underwriting from traditional office to life science and initial lease up of that conversion.
Got it. Thank you. And then Denton in Dallas,
Yeah, Denton Dallas is an easy one. That's a recent delivery. So I mentioned the really strong occupancy in industrial. This is one that just completed construction, also in its initial lease up. Industrial market still fairly strong. Again, moderating a little bit. So this one may take a quarter or two longer than our initial underwriting from a lease up perspective, but rents continue to rise. It looks like it's a large deal with a lot of square footage on the ground, but confident that one will get leased up in a reasonable amount of time. So just recent delivery of construction.
Thank you. And then 70,
And started to build. Yeah, 7190, similar, but just a little further along. So that's one we developed in Phoenix. It's actually the third phase. So it's our third apartment complex, kind of in the same little neighborhood there. We acquired one in 2000 and check me here. First one was acquired in 2019. That one was already leased. We built a second deal in 2019, so we acquired and started to build. 2 years later, that one was leased. Had tremendous success on that second project. We then started a third deal, so that's 7190 you see there. And that one is in its initial lease up right now, getting to that kind of stabilized occupancy. So that one will be stabilized here, probably before year end here, 2024.
And the picture on slide 14 is a rendering of one of those properties too.
Yeah, we've loved those deals. Very differentiated product in the North Scottsdale area, very high-end affluent demographic. These are high-rise luxury apartments, probably the nicest apartment community in the Phoenix area, commanding the highest rents in the market, doing very, very well. They're very distinctive looking to kind of market themselves. They have some hanging greenery off the side. That makes them very unique in the market.
yeah, I see the picture now that you mentioned it. Thank you. Great photo.
Sorry, guys.
Great questions. Anything else I can answer?
Sorry, I had to step out.
It's okay.
All right. You guys are good?
We asked a few questions.
I could hear that. All right. Thank you.
Thank you. We appreciate the support. And any other questions, feel free to reach out to Paul or myself.
Thanks for your long-standing partnership.
Take care. Thank you.
Thank you guys.
Bye, everyone.
Bye.
Bye. All right. What about you?
We need to turn them off or?
No, they'll move. We can move on a little bit. That was the opportunity for 10 minutes.
Yes, in this meeting setting.
Yes, in this.
During the onboarding, we
Right, you had
connected
called.
just with them. We wanted to understand a bit more about
The strategy.
So, very consistent with what we heard back in, I think we connected them as the very first. The very, the value add approach, they have a lot of interesting opportunities that it sounds like they have. I still have the question around, core versus listed is something that we're at least internally debating on, where we want to go. It's definitely true that the valuations of REITs have had a really big run last quarter or so, about 15-ish or so %. So valuation is less attractive, but they're still down. Similar.
Is that driven mostly by the change in interest rate environment? What's the?
So a lot of the revaluation rally is certainly driven by interest rate. I think, and we can talk a little bit more about this. Certainly, we've in the last 2 weeks seen basically a reversal of all of the drawdown in rates that we saw in the summer. But a vision that recession is unlikely, potential soft landing, the Fed's going to cut and potentially cut aggressively through 2025, makes REITs and real estate much more attractive. So,
And you guys are having internal thoughts about public listed.
yeah, we tend to use
Private.
Yeah, we tend to use a lot of public assets, especially when our private market portfolio has liquidity tied up to equity or credit or assets like that. We like the exposure of listed real assets. I was asking the question around the listed REIT benchmark has evolved much more towards more modern industries. The data centers make up a significant bigger portion of the benchmark. And, they're talking about bringing on like data science properties. Again, those are much more common in the REIT benchmark than they are in the core property benchmark. So in terms of the fund being able to add more value, they're going to shift off benchmark. I think their target for the data centers was 2 to 4%. Right now it's still a bit under 1, but it's 0 in the benchmark. So they're starting to shift off benchmark into more modern style properties, which is good from a active, from an alpha generation relative to the benchmark. And from just where the direction of real estate is going away from your traditional office into kind of a more diversified space.
Were you or anyone surprised, and again, it's not my total expertise, that when I asked a question about how you get out, they didn't even pretend to say there's some system. They just said it's their discretion. And that they throw the gates down in order to, protect, blah, blah, blah. Is that something that is in any way surprising, or?
In the core real estate space, I'm not that surprised. There's a lot of, they don't want to do detriment to the rest of the holders. So if there is a big run on the fund, are they going to sell properties, especially at a loss? In this environment right now, they're still sitting on properties that are probably undervalued from where they purchased them. And so they're not looking to sell. I was a little surprised that they have investors who are contributing. They haven't put money to work.
Yeah.
Have the cash and they're not willing to use that to help exit the fund. And again, I think it's tied to they've made promises to investors of we're deploying this in these areas, and they're looking at the deal. They're still valuing the deal. They're still waiting for it to come up. It might not be the full size and not deploy all the capital. Again, that's the manager discretion in getting private market assets.
No, I understand. Again, I'm just talking out loud here because I'm trying to learn as we go. What would interest me or concern me, and I guess this is why we're bringing this topic up, we're talking about this, guys, it sounds to me, and I know we're not traders. I know we don't in any way advertise ourselves as traders here, but yeah, I know. Well, I don't think we are. Pretty obvious. I mean, just based on the way we meet, it's impossible. But at the same time, based on what he said, it means that if we ever wanted to reduce or get out of this because we weren't happy with the market, we never could do it. Because by definition, we're always going to be last. And there's going to be other people already doing it, and they're going to be throwing the gates down. And we're never, so by definition, we will never be able to trade out of this if we really wanted to.
I wouldn't say never. I mean, they certainly can.
But we're always last.
I mean, this is private markets. Like you don't go in there with any expectation of through daily liquidity.
No, not daily, but I'm talking about months or years.
Yeah, I mean, this is like I said, this is private market.
People getting out ahead of us, to be honest. I mean, I think we're so slow to move, as you said, for good cause, that the people who are nimble would
No, I know, but
take advantage of that. I prefer to see a gate than to see them honoring redemption requests that was benefit, which I think would happen.
You're a long-term strategic investor also. So you need a strong strategic case to completely exit and know that it would take time.
well, not even completely exit. What happens if we just decided we wanted to reduce from X to 50%?
And then you wait.
Yeah.
And then you wait. That's
Okay.
it.
Yeah.
I mean,
But we say it so casually. I mean,
yeah.
what's the advantage versus the public markets versus that? I guess that's my question.
That's a fair point.
That's my question.
I mean, when
Making 5%
he
extra?
what he tries to throw in there, and
Yeah.
why do people like private assets? Why do these big people like private assets? Volatility smoothing. All you're doing is just volatility watching, right? You have different opportunities for alpha, but you don't deal with the mark to market of, oh my God, we're freaking out because our REIT just got sold down because everybody puked it and now it's trading at a huge discount to NAV. You get quarterly marks.
That's a positive.
I mean, most institutional investors love low volatility. They get smooth marks, and that makes their portfolio look good.
Yeah, I mean, it does help in our actuarial.
No, I understand from the marketing point of view.
Something that you said I do agree with. $500 million queue to get in, when it sounded kind of, to me, it sounded like a made up number, to be honest. I don't know how you, maybe Josh, you have a point of view. I don't like numbers like that being bandied about when it sounds like it's kind of really squishy.
So that was my question.
Yeah, we got all this investor interest, blah, 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 and then, you either have an interest or you don't. You either have a sale or you don't.
What he said,
Talking with people constructively is not really the same as selling them.
yeah, I agree. I mean, that's why I asked the question. That was a genuine question. I still understand how you could have 550 in and to something out.
Unless
Yeah.
that's not the case, but I don't like the fact that he's citing a queue. I would like to get Josh's response on whether you think that was an appropriate number to cite, sort of like a headline. Then when he kind of explained it, it sounded pretty fake.
I mean, is that a queue or is that committed capital? Like, that's a bit of a difference.
Well, so it is not committed. The fund itself is open. So there is no, you're waiting on capital calls like your Harbor Best. We actually responded to a capital call, but you're waiting on where you've committed, like you still have the assets in your portfolio elsewhere. You're just waiting for them to say, hey, we need whatever the size of the contribution is. This is contribution's been made to the fund, but they haven't deployed the cash yet in a deal. It's possible that as, again, part of their sales process to onboard assets or win business, they have deals in their queue that they're waiting to work on and shuttling out the difference. So there's about a $300 million difference, puts them short of actually investing in capital. Now, the clients that they've sold, we're going to invest in XY companies, now don't have the capital available or have to.
Aren't they investing in the fund? The new investors?
Yes, in the fund. The fund is comprised of all the properties.
Right.
And so.
So they're not investing in a property, they're investing in a fund.
I mean, you could think about it if, whatever, now we're talking their book about how they approach their book.
Or even the
But-
concept, I don't understand.
But they'd be like, okay, I want to wait to deploy my capital in new alpha generating properties rather than just, buying some property that is already kind of rented out for like the cash flowing.
No, I understand. But this is a real question. I'm not,
Yeah,
in a position here.
But
I'm
I-
trying to learn, but if you have a X billion dollar fund, unless people are waiting for them to tell them we have a $900 million tremendous opportunity now you should invest. You're still investing in the fund. Who cares if a new investment comes in that's 50 million or 100 million? How can that move the needle in a way that would make you decide to go in or not go into the fund? I think this is Tom's point. I think the 500 thing is just nonsense. I just don't get it. You know what I'm saying?
We're okay with them citing that number.
That's the capital it sounds like they have on hand to deploy in deals. They have a couple of properties.
But it's not to deploy, I'm sorry, I keep saying it because I just don't understand it. They're not deploying new deals. It's money to be invested in the fund. Somebody doesn't get the return on that new deal. Don't they get the, I mean, maybe I'm wrong. Don't they get the return on the fund?
It's the return on the fund, but like that new capital can come in to do a new deal that's going to boost the return of the fund rather than just buying an existing asset.
But could it move the needle that much that somebody would say, I'm not going to do it until, you don't.
I don't know. I mean, I guess if you're looking at the infrastructure, like the new data center, right? They started out at a $60 million deal. They're going to do 100 million into it, and they're expecting that to, with depreciation, grow a few percent in the fund. So you could look at it that way.
Okay. So people are viewing it as a more attractive fund.
Yeah, more buying. I would see this more buying the story. If you like the story,
Mhm.
so it mathematically doesn't move the needle necessarily. If you like the story,
It's academic. I'm just trying to learn a little more about these products.
I do. It sounds like you're okay with them citing that number. It's not
Yeah, I mean,
disingenuous.
yeah, it's more of, not to deploy any cash back to investors.
So,
Requested, that is, again, manager discretion on how they're handling the capital within the fund. It's according to the structure of the fund and the set of the fund agreements, they have also the LP to the fund. It's their right to not distribute immediately upon us. There's already a quarter of the bag, right? You have to notify a quarter before you like
I saw that.
each cash, and then it's at their discretion how much they're going. When I spoke to them 3 or 4 months ago at the onboarding, the queue is for withdrawals, close to like 300 or 350 million.
Mhm.
They indicate they were going to be deploying it. That's what he had told me, was that they felt that within 12 months they were going to get to that cap. That didn't seem to come across his comment here. It didn't sound like ready to disperse the capital as quickly as maybe he had originally thought. But again, it could be.
Did he make a comment that they just made $100 million and that was down to 160?
I thought he said
Like,
that they reduced it.
early next
That's what I thought he said.
quarter, they were going to have it all done, pretty much paid out.
Well, assuming there are more requests. Right.
Well, this existing queue.
Yeah.
Yeah.
So touching on Tom's point, which I just touched on my point, can you help us understand, and I think this is part of the reason we're doing this conversation, I guess, in addition to just having a reviewable manager. Obviously, with almost any private asset, there's an option for public option, not public option, that it isn't always, apples to apples, but close enough, right? And obviously, in this case, we receive some sort of review. So what would be, is there a historical way to measure the advantages and disadvantages of the private? And I don't think it's a feature that be liquid. So I, I'm saying, and also be at the mercy of their marks, which I don't really like personally, but that's fine. That's the way it works. But do we expect to make an extra 1%, 2%, 4%? What's the?
Yeah, we can get off the top of my head. I don't have excess return of one asset class versus the other. They've over the long term tracked from a total returns, not that differently. But to Principal's point, the volatility on REITs, they are equity securities, so do withstand the volatility of equities.
I actually wouldn't agree with that, but okay. I mean, the volatility is the exact same. It's just one is reported and one isn't. That's all. I mean, it's not like it's not happening. It's just quarterly marks, and so you get a lot less data points. But they own essentially the same stuff, so it's going to.
And I've seen studies that see sustained differences in valuation.
So
A long time, so I'm not going to swear by it. I've seen sustained differences in valuations where there's an equity sentiment that seems to persist for a long time. Public REITs, and it's kind of inexplicable.
I'm sorry, you're saying the privates outperform? Or
No.
what? I don't know.
The equity market's influence on a public REIT can be sustained for quite a while, where the valuations will be higher or low depending on how the equity markets are.
You say there's an outside influence.
Yeah, a sustained spike in equity markets influence on public REITs.
I think I know.
Well, I think in the interest of time, it's been an hour.
Sure.
Right, I think it's
Really?
supposed to be 15 minutes, so it's been an hour. We will
Having
move
fun.
to this topic,
Yeah, sure.
Okay,
Yeah.
we're gonna move on to the next topic.
Thanks.
Right, so
Real estate
I think-
information
I
can
think-
certainly share.
a lot of different reasons to look at this one in light of a portfolio, in light of the IPS, in light of a public, a facsimile, a lot of reasons to think about it. And I think this is very helpful to hear the review. Okay, so let's move on if we could, to kind of, you're now the star of the show.
All right, well.
Okay, thank you.
Good to see you all again, and Ray joined us in the Thoroughfare Trek into Chicago.
Oh, wow.
Some of you have met him, as you all know, Danny McKenna, the RM, who you got to know, left the firm for other opportunities at the end of August. And Ray, a local Fairfield child here, he has stepped into Danny's place. Ray, I get, just a couple minutes on yourself for.
Yeah, I know Josh has a lot to get through, so just a quick hello, and I just wanted to say thank you for being great partners with BlackRock. My name's Ray DeCastro. For those who don't know me, I'm the new relationship manager, as Josh mentioned. I've been at BlackRock about 7 years, sometime at Goldman Sachs and JP Morgan before that. And as Josh said, I grew up in Fairfield, graduated Roger Ludlow. Back then we were flying Tigers. Looks like it's morphed to a Falcon from what I understand. But happy to be here with you. Any resources you need, we are here for you to help you in anything you need. Big news kind of this year so far, kind of out of BlackRock, would be the acquisition we did at Global Infrastructure Partners, GIP, as they're known, is about a $12 billion acquisition. BlackRock is always kind of trying to invest where the trends are. And I think everyone agrees, both US and globally, there's tremendous infrastructure needs throughout, not only in AI, data centers, energy, but even airports, roads, bridges, energy projects. And so that was really the impetus to invest in a trend that is here to stay for quite a while, and now makes us one of the largest infrastructure investors in the world. So I would say that was the biggest acquisition that you saw come out of BlackRock this year. I don't want to steal from Josh's time because I know we're going to go through the ETFs and also performance and talk a little bit about the market. So I'll turn it back to Josh.
Thanks, Ray. I know the next agenda item is the transition, but we'll see it in the performance reports. I'll maybe hit up that just at the front. So I know at the end of August, there was that voted to shift 25% of the collective investment fund, BlackRock CTF assets, into ETFs. So we started undertaking that process the first week of September 6th. We worked on updating our guidelines. As you're aware, we manage to what is in the guidelines of our investment management agreement, which the original investment management agreement had no allocations to ETFs. So we updated that. It took about a week back and forth. Thank you, Carol, from Shepard on the Fairfield side. We began the transition into ETFs on September 16th. So you know there's the notification. The trade with a T+1 settle, you were able to basically buy the ETFs the day all of the CTFs were trading, so you weren't out of the markets. The official date of onboarding the ETFs, we allocated the same 4 ETFs that you use in the OPEP plans, now make up 25% of the liquid assets in the pension portfolio as of September 19th.
So 25% of each bucket.
So we went 25% across each bucket.
Okay.
You're using the same ETFs as you are in the OPEP plan. As you know, the OPEP is 100% invested in ETFs. And so that will show up in the pension report. You'll see kind of a June 30th value of 0 on these ETFs with the corresponding allocation there. We also will, going forward, report on the position of the portfolio where we've set also the 25% marker for each ETF, with also tolerance bands around that. In terms of performance, we'll start with the pension plans on page 3, the portfolio asset allocation summary. No real changes across the total allocation. Rebalance month, raising cash on a monthly basis to make benefit payments. They go out on the second to last business day of the month so that everything at Wilmington can coordinate getting those out to the right recipients. In terms of the portfolio NAV, there was an increase of almost 30 million for the quarter. It's very, very productive quarter for investors. In terms of the NAV change, there was the annual contribution that came in early July. That was 13.1 million. There were 8.25 million that went out for the quarterly benefit payments. So that was a net inflow to the portfolio of about 4.9 million. And I think going forward, we'll expect most quarters will be a negative outflow as contributions come in once a year. Then return was 24.3 million. That comes out to 5.25% return for the quarter. Again, most of the return driven by strong equity markets. Market has been very data dependent. As inflation data printed, you saw a lot of volatility in both equities and rate markets. But most of the data coming out over the summer was more positive. Inflation was slowing. Growth wasn't necessarily as impacted. Labor market was strong. There was that readjustment of jobs numbers at the end of July to August. So there's a bit of volatility right at the start of August. But almost immediately after recovered, U.S. equities, China equities, and UK equities were the big leaders for the quarter, especially China in the last 3 or 4 weeks of the quarter, mostly driven by a lot of the fiscal policy announcements, not a whole ton of detail, but the Chinese government coming out in support of the economy. So China equities rallied. You'll notice when we get to the performance, the non-U.S. equity fund actually outperformed the U.S. equity fund. But again, that's driven by emerging markets and mostly China. On the fixed income side, rates came down very considerably as we went from in June, a lot of bearishness, I think, a little bit on the Fed, and then we saw the positive inflation numbers come out and the acceleration of how quickly the Fed would cut. Prior to the September Fed meeting, that was at about 4 cuts was kind of predicted. It's still kind of hovering in that 3 to 4 range, though it's back up a little bit. Rates on the quarter, the 2-year, which is kind of a good reflection of views of the Fed rates, was down over 100 basis points just in the quarter. Short duration fixed income had a nice rally. 10-year was down 60 basis points. We saw a bit of a re-steepening of the yield curves. The 30-year hung out at about down 40. Of course, all of that is back up just in the last 2 weeks, with the 10-year now about 15 basis points lower than where it was in June, and the 30-year basically on par with where we were in June. So it's been a tough month for fixed
How
income.
about the 2-year? How much did that give?
The two year is back up just a bit more from where we were, but there's still the anticipation that the Fed is going to cut at least 1 more, probably 2 more times this year, and we're baking in 6 cuts through the end of 2025, potential for 200 total through 2026 to get us down.
So there's been no
So-
change in that prediction.
So there's still a little bit of maybe investor fear around, stickier inflation. This has kind of been BlackRock's house view for a while now, is that we thought the summer rate rally was very overdone. We didn't anticipate rates to come down as significantly as they did, or we didn't think that they were justified to come down as much as they did. We think that this is a bit more neutral to where we are. I mean, I've seen some on the street predicting 5 handle on the 10-year, which is a bit aggressive on a bounce back. But again, if inflation stays a bit stickier, you'd see a bit of an increase in the term premium. The term premium right now is still non-existent. So there's still, I think, a bit more to come on the longer end of the curve. So owning long duration, our tactical asset allocation team is short both the 20 and the 30-year points. So we're kind of bearish outlook on long-term rates, but we still think that as the Fed continues their cutting process, we'll hear more from them in November with the expectation that there's a chance of a 25 basis point cut in November. You may see the short end again continue to come back down.
Okay.
Again, the quarter to date or start of the fiscal year, very strong start to the fiscal year. And again, continuing on the strong 12-month period here, very impressive returns. In terms of portfolio positioning on page 4, again, tend to be in line. We have pretty narrow guardrails around the overall asset allocation, and we tend to rebalance on a monthly basis, just given how we raise benefit payments for the portfolio. You'll see here the breakout between the CTF, ETF on all 4 major buckets of the liquid portfolio, as well as target allocations that we have, again, representing 25% of total exposure. Just pause if there's any, just brush the names of all the ETFs I have on the next page, which is a NAV summary comparison. Lots of numbers, lots of lines here, but I think the key point is on the right-hand side, June 30th, you'll see on page 5, a number of zeros. That was the ETF allocation that didn't exist on June 30th that now does exist as of the end of September. We have some updated NAV values on some of the private equity vehicles, as well as the real estate. They didn't have a full Q3, so we're going to wait for their audited report, but we do have a NAV for the real estate. We do have a slight positive performance for Q3 as well. I know that they were alluding to that they believe that there would be a positive performance in Q3 and eventually a full year positive performance, and we have it still under 1%, but positive. In terms of performance overall on page 6, this is where we'll maybe focus up at the top, the liquid portfolio. Again, a strong performance overall from equities and publicly traded assets. Fixed income also rallying rates for a 6% return on the liquid portfolio. And the liquid portfolio, again, makes up somewhere around 80 to 85% of the total portfolio. You'll see in the private equity side, or maybe I'll just go line by line. Again, these are all passive vehicles, so we expect very low tracking error of these. I know the columns is active, but really it's tracking error of the portfolio versus the benchmark. And most of them are extremely narrow. You'll notice a big on an inception to date for the international stock ETF. That's ticker IXUS. Again, this is a little bit of noise of being invested in it for roughly 5 or 6 business days at the end of the month. But international ETFs, international funds themselves tend to have a bit wider tracking error relative to US equities. And there's two pieces here, especially on IX, as it applies to IXUS, is fair value. So the benchmark closes when the local markets close, but the fund itself closes at 4, as they are publicly traded in the US, and ETFs tend to be used as price discovery tools. The price for the ETF itself closes at 4 p.m. New York time. But again, the markets that you're invested in are all over the world. And so there's a bit of a noise over a longer period. Again, the short time horizon that you for IXUS may accentuate how much of a difference there is. We tend to see that this difference in performance is a lot closer to this difference. There's also a modest, and this happens in international, especially EM markets, EM funds, is tax treatment of some of these funds. And IXUS actually explicitly calls out India itself. There's a capital gains tax that India charges to everyone who's invested. So when India rallies, especially relative to the rest of their gains, and as the asset holder, the fund holder has to pay the capital gains taxes on these shares are turned over. And that leads to a bit of a mismatch because the benchmark does not include that at all. So that's a partial driver. I'd say the bigger driver is the timing difference between benchmark close and fund actual close. But again, that should shrink down. You can see the IXUS super fund also subject to that timing difference of 4 p.m. New York close for the fund. Over the whole quarter was a much smaller, tighter band. So this is, I think, at least for the 10 or so days that you've been in the fund, a bit more accentuated from the spike. And then on the private market sides from a return, again, based on our taking over the portfolio the last week of June, we actually had some capital calls and distributions around that and got updated data shortly after June 30th for some of your legacy portfolio holdings. So there is no performance data for this quarter because we already updated to June 30th NAVs in our June 30th report that covered a week. So I would almost interpret the inception to date numbers for those in terms of the quarterly return. Again, hard to judge quarterly returns on private market assets, just given what we just talked about in terms of the volatility smoothing and the lag on the private real estate asset. And as we build out longer term, we have some longer term performance on some of these exact vehicles. We have some details on the next page, but a little bit of a lag on private equity and how much equities rallied in Q3. So we'd expect to see the September 30th NAV write-ups show stronger performance from the private equity funds, just given, again, the quarterly lag in terms of data that we have. We're still waiting on September 30th data for these managers. And then on 7, just the private market details. We continue to manage capital calls. There was a pretty large capital call, HarborVest 2022 fund. We completed I was about to say just last week, but last week was not the last week of September. It was in the last week of September, the HarborVest 2022 fund. So both pension and OPEB made pretty decent sized capital calls. You're still pretty undercalled on the HarborVest funds. What we've started to see in the private equity markets has been a slowdown a little bit of some deal making. Again, part of that is due to how much rates have risen and the anticipation of rates coming down and the attractiveness of valuations potentially increasing as we get towards the other side of this cliff of interest rates. We expect some of the capital to be deployed a bit more heavily in the next 12 months than I think we've seen a bit, again, slowdown industry-wide of capital calls and investments probably over the last 6 to 12 months or so. So seeing HarborVest make that call recently is really the first significant call I would say that we've gotten. We had a call at the end of June, but it was pretty small on one of the Mesirow funds. We're also not seeing distributions come in as quickly. Again, that we expect to also continue over time, again, tied to rates. You have some of these funds have had extensions. The Lexington 2 fund had a 1-year extension. It should expire at the end of the year. We expect the whole thing to be distributed by the end of next year, but we start to enter in some of the extensions on the other 2013 vintages as you start to enter in these 2 to 3 year option windows that the managers have. Again, given where rates are and where valuations are, we suspect a lot of managers are using those extensions, getting valuations up as yields come down and being able to distribute a higher return to everyone and improve kind of the performance numbers. But again, as that drags on, those IRRs will come down as well. I'll pause there on the pension side. We'll go through the same on the OPEB side. Less exciting on the flows because there are none. But,
So I'm sorry, back on page 6.
6. Yeah.
So the CTFs are listed right next to the ETFs. Okay. I just want to make sure we're all seeing this right. So
Yes,
for example, the BlackRock Russell 3000 index would be the CTF.
that is correct. Yeah, the top line of each asset class is the CTF.
Maybe we could just, going forward, label them a little more clearly. So
Yeah.
Not a big deal, but easier for everybody. And then the same as we go down. So the super fund day would be the CTF, right? Okay, no problem.
On the OPEB side, the change in NAV, 90 million to 95 million, so it's 5 million appreciation in the fund, again, tied to investment returns. Bit higher return from the OPEB account, just given the higher equity allocation. Equities rallied a bit more than the fixed income assets. We saw a bit higher return, and that even extends beyond if you go back 12 months as well, almost 400 basis points better performance. But again, asset allocation driven on that side. There was no transition. Obviously, these were all invested in ETFs for the quarter to date as well as inception to date. Similar on page 10, the asset allocation and portfolio targets. Again, we have similar target band. We'll let this float a little bit, but we try and stay as close to benchmarks as we can, especially around quarter end. We're not raising cash for benefit payments, so we don't necessarily need to worry about finding cash or adjusting the portfolio around raising benefit payments. But we do like to stay close within our target guidelines for the portfolio. And then performance, NAVs on page 11. There's no zeros from the prior quarter because we've fully invested in these funds at the onboarding of the mandate on June 24th. Private equity lines are a bit lower than the HarborVest funds in the OPEB account rather than legacy holdings. As well, you still own the principal. I'll note, also to Ken about the contributions to redemptions, you are under allocated to your SAA in the real estate. We haven't made a new contribution to that. We're keeping the market value as is. There is a small buildup of cash. You'll notice 205,000 real estate line. It's tied to distribute. There's the component there. It's not big enough for us to send back to them. What we'll typically do is reinvest cash that we have in the portfolio into the liquid portfolio, so into liquid assets to put it to work. But you're standing at somewhere close to under 0.5% of cash in the portfolio, as it's not causing too much drag, but we will look to deploy that every 3 to 6 months as it builds. We'll redeploy cash. And then again, from performance, these were fully invested. So I noticed at IXUS, the tracking error was 68 basis points per quarter. I saw on the prior page. On the pension account, but again, over 6%, over 6.25% return from the liquid portfolio, driven predominantly by equities. You mentioned non-US equities out in the US, driven by a strong yen performance for the quarter. But again, not too shabby from the US. That continues to be, from an individual country perspective, the winner over some time. And again, the fixed income assets appreciating from rates coming down over the quarter. Credit spreads narrowing tightly. They're basically at historic tights. So we don't expect kind of the spread compression to be adding much value from an ag perspective. So still pretty rich driver of our. And similar details, way less invested in the private equity space on the OPEBs. Again, the HarborVest 2022 made a capital call. The pension was it's 2.5 million on the OPEBs, at least one of those.
How much?
It was 400,000.
So so the one thing this board didn't do is make a allocation or decision about an allocation of private equity.
Yeah.
Right? And so, we did 21 and 22 and 23, not to 24, which may be a blessing, right? Or it may have been this opportunity. But I think that's going to be something for you want to take up. Right?
Yeah, and one of the things that we would look to help you with is run, I'm sure Vanguard did with helping you determine what years you want to like how much of a commitment to make. I suspect a little bit on both the pension and the OPEB relative to strategic targets, maybe pretty significant commitments up front to the HarborVest funds relative to the total allocation percentage of 10% target for private equity. The HarborVest commitments themselves are 100 million, so pretty sizable relative. Again, they've been slow to ramp up. The industry has been slow to call committed capital in the last, several months or quarters. So what we look to do is help you and run a pacing study through our private equity team to help gauge when commitments to stay within target.
Heroic Carolyn Tribuco deal with HarborVest. What was the going forward? I understand we obviously have our investments with them.
Oh, so,
What
well,
was-
so,
what was
so,
the-
no, the deal was that we were under Vanguard, we were put in a fee class that was
Right.
very low. So they honored that going forward for the three
For those,
funds we're in,
right.
but that's it. We have no obligations and we have no privileges and no special deal going forward. But we will have the low fee
For the existing,
for the existing,
but not for the.
but not for
Right,
any,
that's something that should
but not for any future, right? So we are.
red mark or make a note of that mentally for our future discussions.
Right. So this board is, so we're free to do whatever.
Right.
Free to go wherever, do whatever.
Mhm.
And the great thing was knowing how difficult it is to withdraw from a private equity fund once you're in and going, the fee differential would have been quite onerous.
Yeah.
And they
No, that
agreed
was-
to keep the fees.
One of your 6 great things.
Yeah.
you did.
That one
Yeah.
was that was the.
Mhm. Yep.
That was the Christmas to New Year's feat of feats.
I think that's wonderful that they gave.
No, they didn't go willingly.
Oh,
That was-
No, no.
That's not surprising.
No, that was not pretty.
The fee competitive relative to industry is the HarborVest funds. I'm trying to remember again, is it in the 20s for management fees?
Yeah. Really low,
That's a
really
great.
impressive. And it was going to reset something about 3, 4, 5 times higher. And would have resulted in, an incremental $15 million of fees that we would be paying. Right? I mean, cumulatively, a huge number. That one was,
Well done.
that was not good.
Mhm.
So, yeah, so a pacing study makes sense. So the one thing I think that Vanguard missed in their analysis was exactly the point that you brought up, which was we were making such large investments. I mean, those were very large allocations to the HarborVest funds. And we were not doing the right pacing studies. I mean, we're looking at it as a percentage, but when you're looking at the capital calls and how they all could come in, they didn't do a level of rigor of analysis because that's not what they do. But I don't think they know how to do the analysis. And so I think that would be very, very helpful.
And our private equity does this. They have manager by manager. They know the HarborVest funds. I approached them already this summer, mentioned the HarborVest funds. Like, oh yeah, we know. They're aware of kind of what to expect from distribution. They have a bunch of analysis on distribution, capital call timing that they'll run stochastically around the total
Okay.
portfolio, just to make sure that 10% target that you have now, kind of trying to maintain that. We can talk more details of
Yeah.
what exactly we want to go through, how comfortable we are with the 10% target to maintain. Is there, you have tolerance bands around there. What does a schedule look like if we allow that to drop a little bit, or if we want to maintain?
Yeah.
I think that's definitely an interesting analysis, because they'll help,
Well, since we're not getting any favorable fee treatment going forward, so it opens up the universe for us to,
Totally open
Yeah.
universe.
so,
The other important thing going forward is the OPEB NAV is of such a size that the town would like us to do collaboratively a study to look at perhaps starting to permit distributions out of the OPEB funds to pay for some of the OPEB expenses for those who contributed into the OPEB fund. Right? And so there comes a point in time when the fund has reached a size and a maturity when it can begin to allow for some distributions out. So the question would be, to whom, how much, how would you pace that, right? So that way you're not depleting the fund, but you're doing it at a right pacing, which would then cause you to think about how does the asset allocation overall have to change for OPEB, right? Because it is tilted in a way that is much more toward equities.
well, it's been treated as permanent until now.
It's been treated as permanent because there are no distributions.
Right. Can I put, ask you one question? This is new to me. Everything you said made sense, except you said to whom.
Well, because not everyone contributes into OPEB.
No,
Right. So
but dollars are dollars. I mean, to the recipient.
No. I mean, and Eric might be able to. They came from certain union employees, certain unions. It's for the benefit of certain unions, certain collective bargaining units.
Okay, I guess I don't want to get, it doesn't matter, but it doesn't change the flows of benefits to people. Nobody's getting more or less because the money is in a different place to begin with.
The money. So
I still don't understand what you said.
It's a town versus.
It's a town
Town
versus open. Right, but it has nothing to do with the employee side, in terms of the receiving of benefits.
No, it's money. It's
Money,
how money works and accounting
Yeah,
and
okay,
controller and
Sure.
tracking of funds and then how it. But it's going to require a study.
Carol, on this point, what's the scale of the current town payments for the OPEB beneficiaries relative to the NAV?
I don't know.
Just a couple percent or something.
No,
Yes.
Caitlin
Don't know.
knows this. Caitlin Bossie's been studying this. She's been trying to, she's a controller. And she's been trying to get her arms around it. It's a significant expense.
It is significant, okay.
It's a significant expense. Like it's not, this would be a small portion to offset it,
Right.
not to cover it.
That was the magic number that town is setting, like, hey, you reach this valuation, so now it's time for you guys to kick into the kitty,
No.
or is it, so they're asking us, it's not required,
Correct.
and we
Would
can
you-
say,
Is there a number? It's time to start talking about, is there a number?
is there enough? Okay.
Is there a number?
Would have been nice if we had set out at the outset some targets. So that it would have been
Well, on that-
I
objective.
feel like you kind of, we're at the point where this, I gotta learn more about the OPEB, but then you're just like any foundation or endowment. Can you
Right.
pay out 2% a year
Right.
of your fund for operating expenses and you build it out?
Right.
And I had a question also, maybe this is for you, Josh. Is there a level where it makes sense for a fund from an account sizing point of view, size for the OPEB fund? So if we start depleting it with beneficiary expenses, suddenly we worry, if we put X into this particular asset class, it's going to be too small to beat the hurdle to get, beneficial, right, speaking of Harvard, that's a beneficial.
I mean, you certainly think about private market side, size of the OPEB shrinks.
Right.
You're locked in the private equity side.
Hey.
So you have, 13
Yeah.
million committed. Uh,
No.
Yeah. So, that might impact
Yep.
what pacing looks like to keep it at a 10%
Yeah.
target. This will eventually draw down in terms of size. Now, you're asking offsets, you're only going to pay this up,
War between.
but, you know,
Yes.
there's definitely.
Yeah.
Yes.
This is, I mean.
Yes.
You know, once you start paying out money, they're gonna say, well, you
Not
can't
just
turn
that,
off,
This
you can't
could
turn off
have
tap.
massive impacts on the budget. This is.
Exactly.
This is
All
ludicrous.
of the above, which is why it should start as a study, which is why it starts as a study with the.
This is a landmine. I don't think you guys realize what kind
No,
of.
no.
Actuary.
This is, actually,
The
this is.
actuary, it starts as a mathematical study. But it starts with the math.
Right. And to Nick's point, the way that you can envision, not funding, putting more contributions into the open, so that fund exists, almost as like running a spending study that has been a down.
You can't say that.
Right.
But I imagine I might have some ability to negotiate the kind of the size, maybe set that as a percentage of net that we're willing to disperse. Which is probably.
Sure, I agree.
Everybody, I agree, sure, it's an hour that, and then that's a question on size of their assets.
I didn't want to log down. If it's that, they're not connected every time.
What happened to a couple days ago?
Exactly right. If we can say no, okay.
Can I jump in here for a second?
Yeah, go ahead, Eric.
So, there were very strict guardrails that were put in place when the OPEB trusts were established. And the reason those guardrails were put in place was because we knew at some point we'd come to a day where the town would want to remove equity from the fund. And you could trade it either as a checking account or a savings account, hybrid of both. So I think you have to look at the language of the trust and how it's established, and the language that currently resides in some of the labor unions that protects the trust from being money taken out of it. There's very strict language. So before did not know that Caitlin was doing a study.
She hasn't started a study. No one has started a study. The way that she approached me to say, has it reached a size that is now large enough that we can do a study? Right? And my response was, I have no idea. But if there is to be a study, it should likely be done by the JRIB
If I've ever heard of
Kind
a
of-
need for a subcommittee.
under the tent in a collaborative way, but kind of in the purview of kind of the JRIBs,
Okay,
And
okay,
the-
let's not dwell on it, like you said, well,
right? But it's rumbling around. Is there a number? I think the question is there a number at which we talk, at which they start talking about
I would
it?
think as a board, we should let the town approach us and then respond. I don't think we have to do anything at this moment in time.
Well, expect the town to approach.
Yeah, no, let them approach us and no, say,
Approach.
yeah, I understand, and then we'll, but I mean formally,
The town is approaching.
then we will, decide among the things that I would like to explore, and then I think we should move on from this is whose prerogative is it? In other words, if we decided as a group that X dollars in here doesn't sufficient for us to feel comfortable sending money out, can we just say no? I don't know the answer to that question. Eric, maybe you know the answer.
I don't, but Carolyn did touch on one specific point, and it was something that was at least written into our collective bargaining agreement, is that distributions, at least from the police fire trust, would only be made for those that contributed to the trust. So that was one gate, which made sense, right? And that was just because we wouldn't defer that healthcare benefits were being paid out of the budget as an operational item, and then as employees like myself who contributed to the fund for almost probably.
Eric, do you know
20
if that's on
20
a
years now.
nominal basis or an invested basis? You know what I'm asking that? In other words, if you put in $100 over the course of time and it's grown to $200, does that mean that $200 is eligible to be paid out, or your $100 cash inflow.
No, the current gate in the CBA is that as long as members who paid in would be the benefit of the trust. So there's a whole segment of the retiree population that
Right,
existed before the trust was established, right? Prior
Right,
to
sure.
2007, let's say, right? So
right.
as me as a member and all of my brothers and sisters that contributed to that trust, that trust was kept because that was part of a negotiated deal, that the trust would be established, that we would take care of these OPEB liabilities in the future, and that the town's liability that they incurred prior to 2007, right, that wouldn't come out of the money that I contributed out of my budget, right, out of our contribution. So it's very complicated. It's very complicated.
too
It's probably
complicated.
nothing we can solve here. The only thing that isn't that I would like to see.
Right, no, I get it. You're out. You're good.
Right.
The only thing I would like to see is that there's probably some funding level, right? There's probably some funded level that we need to look at. And I would assume, I mean, when you start looking at pension funds that are in trouble, you look at some number, south of 60, right? Or south of 70%, right? So the OPEB trust, you probably want it to be at some level of like 60, 65, 70% funded before you choose to take money out. If we're at 40% funded
Yeah,
and we're considering taking money out, that's not just to offset taxes. I don't think that's the right
We
thing
could talk
we
about
should be
this for a
doing.
long time.
Yeah.
I could-
Yeah,
There's so many documents maybe
Right.
preclude.
yeah. Okay, there's work to be done on this. I think,
But that's coming, right? And so but where it will be most relevant to the conversation you have before you get to that number is gonna be private equity with OPEB.
right.
Because that's where you will be locking in, you'll be committing to something for a long period of time. So that you want to be sensitive to the allocation.
Somebody's gonna have to get a calculator out.
Okay. So, so.
Okay, but future.
We're good?
No, I'm good to go.
Thank you.
All right, All right, so we're gonna move forward. So, point number 5, guys, this is, very exciting day for me.
Yeah, right.
After many, many years, guys, this is my last JRIB meeting.
Mhm.
I have, you've been part of my life for a long time. I want to thank you all very much. It is, always difficult to kind of say, okay, this is it, it's time to go, but, I had to make the call and, figured this is the right time. You've got BlackRock in and onboarded, and this seemed like an appropriate time. They we were moving into a fair spot.
Let me
So,
interrupt you quickly and say that you are appreciated beyond anything you'll ever imagine. So I want to present to you on behalf of everybody this plaque. I'll read it out loud. The town of Fairfield, everybody can see it on video. The town of Fairfield, Connecticut proudly thanks and appreciates Carolyn L. What's else?
Luther.
Really?
Yeah.
Tribuco for her outstanding leadership on the Employees Retirement Board and the Joint Retirement Investment Board, October
Oh, thank
23rd.
you.
You're welcome. You really deserve it.
Thank you, guys.
Yeah, with the return rate that you should.
No. But I will be asking everybody at the door to give me $8.
Thank you. Thanks, you guys.
You're welcome.
Investing in then you resume.
Welcome.
Yeah. What was I thinking? I should have gone before that. I'm like, woo, you
Yeah.
take it.
If you get one of those.
Well, thank you very much. This has been it's been an honor and a privilege, and I got to tell you, I've gotten phone calls. It's been really nice. It's a great way to get to know the town.
Mhm.
So I leave it in great hands, and I can't wait to see what you guys do and carry it forward. To that effort, even though the December meeting will be the annual meeting and you'll elect new officers, it would be remiss not to leave it with new officers tonight. And so, to that effect, I'd like to nominate in my place, a chair to take over. I'd like to nominate Ken, to step in,
I'd second the nomination.
right?
Appreciate that.
Accepted.
Reluctantly, quite seriously. And we'll see when December comes up if you guys still want me to be in that position. Although, if anybody else has an interest or an opinion, I'd like to hear it. And also, I hope Tom will be willing to stay on as vice chair.
Being the most senior member, I think, on the pension board here, I think it's a great team to lead us. Thank you very much for stepping up, both of you.
No problem. No
All right.
problem.
All right.
Big shoes to fill, to say the least.
All right.
What's that?
I was just thinking the same question.
So we,
Frightening.
so
Do we have anything else?
do we consider that a unanimous vote? There,
Is it a formal process?
I actually don't know.
It's
In between
vice
meetings.
chair, it's an in-between meeting. It wasn't noticed, it wasn't anything, but you were an officer, so,
Mhm.
we leave it in your capable hands for the next 6 weeks.
Okay. Okay, very good.
And,
Okay.
old business, new business, I guess that's it. So,
Next meeting.
I have an item on new business. I know we've been using Pomerantz for litigation securities monitoring company. I was approached by someone from Wolf Popper. They wanted to know if they could come in and pitch us. I don't know if you can have two litigation companies at the same time as a primary or a secondary. I know it's not a lot of
We
money,
don't
but
have-
it is something for diligence.
don't
Say,
say-
hey, here's what you guys might be.
Yeah, they find something and they go.
Yeah, then they go for it and they get a percentage.
Yeah, so if you guys don't mind, maybe the next meeting or the meeting after, I'd like to kind of bring them in and just have them do an introductory meeting and,
Eric-
pitch
Eric,
what they
could
can do
you-
for us.
Could you please send a message to BlackRock on that?
Yep, absolutely.
And see- Okay, and coordinate that?
Absolutely, absolutely.
There you go.
Perfect.
On that note, would I be, I've
Delegated.
always been a little uneasy with the security litigation stuff. I know we've made some money.
Mhm.
We put in some time about hearing how it's low risk.
Mhm.
Would it, I was going to propose that maybe put on Josh's broad shoulders. Is there somebody who's familiar with this kind of litigation in the securities field who can say, oh yeah, this is fine, well worth it? Or there's something out there working that could actually, so I'm just asking, but I don't know. I've always been a little uneasy with this, to be honest.
Yeah, sure, not necessarily from our OCI, Ray, I don't know if we have internal resources or partner firms. Maybe we can take
Yeah,
that.
let's take that away because if we don't have it internally, there could be a lot of connectivity with others that we can try to figure that out. So why don't we take that one away?
At this point, just to emphasize, I'm asking as an individual on the board a question, so not committing to anything, just love to
No,
hear
of course.
somebody come
So
back
At
and
the
say,
very-
oh,
at the very least, why don't we, I think it's a great comment, Tom, only because between you and Eric here, we've had the people at Pomerantz, who as far as I can tell, have done a good job for us and they monitor this stuff and they bring it to us and blah, blah, blah. But just because something is free doesn't mean they're the best at it. So it couldn't hurt to have you guys look into it as a concept and if it's something that other organizations do and if it's considered a good or a bad or successful, whatever it may be. And at the same time, if Eric wants to help us be introduced to another vendor, so to speak, we can decide whether it makes sense to stick with one or the other, or we can just put a notice in the newspaper that anybody who wants to find these things for us can bring them to us. So I think that's the way to go about it.
We have an update on the implementation of the portal?
I didn't check in
Okay.
with them ahead of this, that you can put on, just, an update on that. It should be there. I mean, it should be.
What are you talking about? now, sir?
The Milliman portal for employees and the money to logging in.
Oh, okay.
Stuff and see where the implementation are.
Yep.
They're close.
Mhm.
Yep, they included your language.
No, this, thank you. Yeah, thank you.
All right, guys.
December.
Yeah, I was just gonna ask, do we have a date? What is it?
Yeah.
Oh.
It's,
Usually do like the fourth Wednesday, is that right?
it's just, no.
Early December. The fourth Wednesday of Christmas, so it's.
Well,
what's the December rule?
so
That's it. We're doing it on the 25th. We're gonna really test who's dedicated.
The first week in December. I thought.
yeah, you guys, it is, if the JRIP is on December 4th.
Yeah.
Wednesday, December 4th, it's the annual meeting. This is the one, because otherwise it's
Okay.
at Christmas time.
So Wednesday, December 4th.
Yeah, and that's the one where you will also present the schedule for the committee.
Right.
Right, so you'll get the meeting here and you will set out, you guys should get together and set out an agenda schedule for the year.
We
Right.
talked about going quarterly and then we.
Well, that's-
Stick to it and then we had special meetings and.
Right, so you'll have to determine the cadence, right? Because we were 8 a year, well, 9 a year. And then switched it down, pulled it down to 6 scheduled meetings.
Right.
Right? And then, of course, the retirements will still go when they need to go. And you'll have to determine if you want it to be 6, if you like that schedule, or want to add
Yeah, I think we
Yeah.
need to.
Or you wanna add
Board feels.
more to it. But the December 4th meeting is when you would vote that. And once you vote that, you'll then have that sent over to the town clerk, who will then put that on the town calendar. But what's helpful is to have the agenda, the rough agenda for each of those ahead of time. So like in July, you'll bring in the actuary, although we,
What we do with budget, so are we moving that up? We're moving all that up to talk about that earlier now?
so we can now do it in December,
Right.
right?
So there's not a big surprise.
Right, but we
Yeah.
don't do it during budget season. We never do it. So you would either do it in
I
December.
remember if we were talking about changing the discount rate or we were changing our
We
tables.
can why don't we adjourn the meeting? All right, and we can do this offline.
Yes, we're believing, we're gonna be thinking.
Yeah,
for
right. I
quite a
still
while.
live in town.
Yeah.
I still live in town, you know, I still have to know where everything is.
We expecting someone to be appointed in your place at some point?
We have somebody
Oh, we do.
on tap.
Okay.
So we will.
All right.
No,
If-
no, I mean, it's a wonderful. You want to introduce yourself to the table? Sure.
Yes,
George Lees.
Just give us an hour or two about your background.
I guess tonight, and I guess I gotta go to the town RTM at some point.
You're on the,
Formal.
I'm sorry, you said you're police and fire?
No, I'm
Oh,
the town,
town.
yes.
Yeah.
Financial background, Wharton School, financial background, CFO and controller, WPP, Young and Rubicam.
Okay.
Most recently on their pension and investment committees
Oh, great.
for the last 10 years. And I just retired.
Congratulations.
So,
congratulations.
I won't hold Wharton against you.
yes, exactly.
Oh, wonderful. Yes, we should mention that Jim Brown did,
Yeah, oh, yeah, it was-
so Jim Brown did resign from the board.
Yeah,
Oh,
So that's it's a vacancy,
yeah. yeah, it's a
right?
shame.
And then my
Great.
seat will be open, right? So there are 2 vacancies and there are,
Wait, there's two,
yes, and with mine opening up tonight, there were 2
that makes
vacancies.
2.
Yeah, and then I think we have 2
Wait, you include
great
George.
candidates.
Wait, George is, oh, you're not officially on the board yet?
No,
Oh, okay.
See it for fun.
Here for fun to see it in action.
Right.
You can pop out anytime. You can.
You can be like, hey, you guys.
He will just go.
that's not my real name.
That's right. Yeah, next week we'll get Jose, whatever, and be like, who's that?
All right, our motion to adjourn.
Second.
All right, everyone, thank you.
Thank you.
Good-
Carolyn, again,
Thank
thank
you.
you.
Carolyn, congratulations.
Stop video over there.
Thank you.
How do I do it?